Welcome back. Let's talk economy now. The second quarter GDP numbers are due on Wednesday this week, and the market estimates are ranging rather wide between 5.6 and 6.5. Additionally, with the budget coming up, there is a lot of discussion on next year's GDP and inflation numbers, because on that will depend the nominal GDP, the tax assumptions, the deficit assumptions. Joining us now is Santanu Sengupta, the India Economist at Goldman Sachs. They have just brought out their GDP forecast for next year. Shantanu, good morning and thank you very much for joining us. Well, I will have to start up with the Q2 numbers. What are you all calling?
So we are looking at, thanks Lata firstly for having me on the show. We are looking at 6.3% year over year. That's not very different from consensus. Consensus is at around 6.2%. The main story is that the reopening boost that we have seen, and it carries through into our 2023 outlook as well, that the reopening boost that you've seen on consumption and services, that is fading, and that will fade further into 23. And the monetary policy tightening cycle that you've seen, which is the financial conditions tightening, that will start weighing on domestic demand as well. You will also see a net export drag because Europe is slowing down quite sharply, but that's more into this quarter and into next year. So overall, we are looking at 6.3% year over year.
No, I was coming to your numbers, but you refer to it as 2023 GDP growth as 5.9. Is that different from the FY24 that we talk about?
Yes, so that's the calendar year number that we are looking at.
So if you could give me your FY number for FY23, FY24, what would that be?
Yeah, so the fiscal year 23 number is 7.1% year over year, and the fiscal year 24 number is 6.0% year over year. Whereas the calendar year number is comparing as 6.9 and 5.9. Okay.
Sorry, what is the 24 you said?
6.0. So 6%.
Okay, just 1 point, 10 basis more. Okay, now I wanted to come to the, the argument you are making in your report that next year, second half, you will have the benefit also of the capex cycle starting. The government will continue to be able to spend more because of the tax buoyancy. Can you dwell a little more on that? Can we expect that kind of tax buoyancy next year as we saw this year? Any numbers?
So particularly on the tax buoyancy, the budget is still 2 months away, and we are yet to look at, what the numbers could look at exactly in terms of taxes. But broadly, the capital expenditure view is not just contingent on the government spending on capex. I mean, the government has spent, 1.5% of GDP pre-COVID cycle to about 3% of GDP now. So that's almost a 1.5% of GDP increase that you've seen in the central government's capital expenditure. But there are a couple of other things which are going on in the capex cycle. One is that the manufacturing companies have deleveraged over the last many years, but especially into the COVID cycle as well. The manufacturing companies have deleveraged, so balance sheets of those companies are looking better. Capacity utilization is reaching closer to 75%. In fact, if you seasonally adjust the data, the non-seasonally adjusted data is at 72.5%. But the seasonally adjusted capacity utilization is running closer to 75%. And the bank balance sheets are also in a much better position now than what you have seen in earlier cycles. So all this is creating conducive conditions in our mind for a capital expenditure cycle going on after the effects of the monetary policy tightening and the global growth slowdown passes. And we are looking at it more into the second half of next year.
But in spite of all the good things that you are enlisting now in terms of better global recovery, rates peaking off, capex cycle starting, your growth number is not very flattering. You're only at 6% FY24 and 5.9 calendar 23. Why that?
Because the offset is still coming from the consumption boost that you've seen that's fading away, right? So you had 2 very sharp contractions in the 2 COVID waves. Especially post the second COVID wave, you've had a very strong catch-up in consumption as well as services, which starts services as the economy fully reopened. But now that the economy has fully reopened, we think that that boost from the reopening trade is over. Financial conditions which were extremely benign throughout the COVID cycle, that has started tightening, and hence that will start impinging on the consumption outlook going forward. Whereas we are expecting some of the offsets to come from the investment cycle. Uh, Thirdly, as I said, the net trade drag will continue at least into the first half of the next calendar year, because that's when Europe will go through the slowdown. But thereafter, we are expecting the global economy to recover, and hence some of those boosts should come in the second half of the year rather than the first half. So what you're seeing is the number on an average at 6% roundabout, but I would call it a tale of two halves in terms of growth. The first half slower, but the second half we are expecting it to be stronger.
Okay. Well, let me come back to the budget numbers. I know you all have not done, as you say, what the tax expectations can be, but you have your nominal GDP ready for next year. You're expecting inflation to fall to 6.1 average from 6.8 this year, and you're expecting growth as well to fall, real GDP growth, to 5.9. In that case, the nominal GDP will be less. So will the government really have that much money to spend as it had this year?
So there are two things going on with taxes. One, of course, is, as you're correctly pointing out, the nominal GDP effect. Two is also the formalization of the economy, resulting in higher tax bouncy numbers. So one is the nominal effect, which is more from inflation. Two is the formalization and the bouncy effect. We think that continues into next year as well, and you can see that play out already in both the direct and indirect taxes numbers, as well as the GST numbers. More importantly, in our view, from the fiscal strategy point of view, as you head into next year, we think there'll be two focus areas for the government. One, they will be focusing on the capital expenditure, because that has the opportunity of crowding in the private capex as well, because that has been the primary driver of the capital expenditure till now. Two is that you will probably have to keep some allocation for the subsidies going forward as well. If you get surprised on the upside in terms of, let's say, something like fertilizer prices, then you might not have to give as much fertilizer subsidy into next year. And that room can open up either for fiscal consolidation or for allocating more towards capital expenditure. But absent that, given the volatile commodity environment that we live in, the government would possibly allocate a prudent amount towards subsidies as well into next year.
Okay. Oh, well, before I run out of time, let's discuss the external situation. The last quarter, barring this month, November, was a time when we saw the rupee under some pressure. You are expecting that pressure to have peaked. Now we are going to see the rupee appreciate?
Yeah, so remember the last time we spoke, we were quite concerned about the external balances.
Yes.
From the domestic front, though, nothing materially has changed. So we are still looking at the current account deficit in the region of 3 to 3.5% of GDP, both this year and into next year. But what has changed is, in our view, the dollar is peaking out or is nearing a peak in the next couple of months or so. As the market starts to price in where the Fed cycle terminal rates will be, that is possibly when the dollar peaks. Once that is over, then emerging market central banks will find it much easier and will have higher degrees of freedom to operate even with lesser reserves. So earlier, the reserve number at $500 billion was raising question marks when the dollar cycle was really roaring and it was peaking. But now that the dollar cycle, in our view, is peaking out, the emerging market central banks will find it easier to manage currencies. So as it peaks out and the dollar weakens over the course of next year, we think that the dollar rupee level peaks out at about 84 in, call it, 3 months' time, and then appreciates towards 83 or 82 in the 6 to 12-month period.
Okay. And finally, you are persisting with your view that the Reserve Bank goes with the 50 basis now. The Fed, the minutes clearly show that they are softening. And inflation numbers are also, even from the forecasters, is softening. You still go with 50 in December?
Yeah, so we still have a 50 basis points for the December policy. With what is happening with oil markets and overnight over the weekend on China, and especially if that causes a further reduction in oil prices, that can cause some downward risks to that 50 basis points forecast. But overall, our view is that the inflation story in India, from the core inflation point of view, still remains fairly concerning because your output gaps are still closing or nearing closure, and your core inflation is still persisting at about 6%. So our view mainly is that although core goods inflation tops out and starts coming lower into 2023, core services inflation will still keep growing and grows from about 5.5% towards 6% or above as you head into next year or middle of next year. And hence you will need a period of positive real rates in the economy, and then we bake in a cut by the end of the year. So we are peaking out in terms of the repo rate at 675, but then we actually pencil in the cut by the year end if the inflation view, especially the food inflation view, also pans out the way we are thinking.
Well, that's far out, so I won't, develop on that point. Just a final quick question. Is there an upside bias to your next year's growth forecasts?
We think that the risks are fairly balanced at this stage. The upside bias in the second half could come if Make in India really plays out. So the PLI schemes gain traction, and you have a lot of FDI flowing in that causes the investment cycle to grow faster than what we are anticipating. That can cause the upside risk as we head into the second half of next year.
Okay, well, the way the equity guys speak, it looks like there can be a financialization wave, and that can also perhaps create a wealth effect, but that discussion for a day-to-day. Shantanu, thank you very much indeed for joining us with your take on the economy. Let's see what the numbers tell us on Wednesday. We wrap up on this edition of Bazaar. Thank you very much for watching. Trading Ideas coming up on Chartbusters.